So much can change now within the next 10 days or less.
Hi again, everybody. Welcome back to the Comstock channel. I'm Marlin Bohling with you. Always a pleasure to have you with us. Well, we're going to talk about Wednesday's market activity in today's episode. And with me, I have Joe Camp of Comstock Investments. Make sure you like these videos and subscribe to them by clicking that bell icon down below and share these videos with others too. We sure appreciate that. Okay, so I had a little give and take during Wednesday's session here. Seems to be a few different things at work. So, Joe, can you kind of navigate us through what happened during the trading day?
Seems like a breather after a strong run up for corn and soybean futures, several sessions with the last leg higher sparked by that Friday crop report, and then met with some resistance, both on the technical side. We have decisions being made by the speculators who are heavily net long the corn, but still net short last recording on the soybeans. And that comes into play when we look at more bullish conviction on the corn having some gains to speak of at the end of the day today, and the soybeans being lower and still talking maybe more about short covering as opposed to fresh buying interest on that end. And then on the other form of resistance, some pushback potentially from farmers selling, and that could include more active farmer soybean selling as opposed to the corn. And that's one thing I think is interesting, a carryover from the last crop report, that we look at the latest run up and the relative strength for corn. Farmers really have met that strength with sales, and much more aggressively than we were talking about a year ago. That was a big problem really for the corn market a year ago, that we were carrying such heavy old crop corn stocks into the new marketing year, whereas we normally are going to let go of those soybeans first in a bigger way. It seems this year some of the data suggesting that farmers have hung on, maybe because of the lower depressed prices, and thinking that it was a wait and see attitude now that the new calendar year is rolled around and that we have had a considerable enough rally for soybeans. I think it was met today with against corn, more farmers selling, as well as that technical resistance showing up in a bigger way for the soybeans. But nothing out of control. Soybeans bounced from their lows by the end of the session. Corn higher, wheat mixed, pretty quiet, all things considered, for what's been going on.
So, what was your clue? What do you go by to determine if it was active farmer sales? Is the basis changing around the country, or what do you go by?
Basis, we can see weakening in a lot of areas after the board rally. It's anecdotal as we talk to customers as well. It's, again, a relative type observation to corn, and knowing that there was a lot of corn sold on those last several run-ups to 450 and higher. And you didn't have that same strength until just about a month ago. Well, the corn's been rallying, since its late August low, whereas soybeans, it hasn't been since now just less than 4 weeks ago that they were able to turn a bottom. So the other item I'd like to go back to that crop report mentioned, and it's the grain stocks update, somewhat overlooked because of the attention on the WASDE and how it factored in these new yield estimates, which were such a shock. But the grain stocks update, if you look at corn overall, the stock's up 1% from a year ago. But on-farm stocks are down 2%, while off-farm or commercial inventories are up 2%. So relatively speaking, for the increase in total stocks, there's been maybe more of it moved into the system and sold by the farmers. It's the opposite on the soybeans. Whereas again, normally we're going to think about much more heavier selling by now and more of a transfer from on-farm stocks to the off-farm count. Well, soybean stocks Friday called up 3% in total, but the on-farm stocks were up 6% and the off-farm were down 2%. So you can see that relative difference in what was gained in terms of total bushels over the year. Well, more of it was seemingly transferred on the soybeans into the commercial channels, or the corn rather, into the commercial channels than the soybeans, which farmers, relatively speaking, again, are sitting on more of here. But yeah, that was potentially just up until this week with a more active sell side pressure. I think leaning on the beans today.
Well, yesterday, of course, in this episode, I was talking with Matthew Cruz, the president of Comstock, and he is in Brazil right now. And he was talking about the change in weather forecasts down there. He admitted that there are likely fairly sizable crop losses down there in southern Brazil and northern Argentina. But he said the weather looks like it's going to turn very wet next week, maybe 3 inches of rain or more in some areas. And I just wondered, is that what kind of pulled the rug out from underneath the market today? I mean, are the traders getting a little bit gun shy now with maybe some rain in the forecast?
That would seem to be another influence for me. The talk about Argentina, for one, we had the meal market back lower today. We attached meal to Argentina because they're projected to be the top exporter here in 2025. And it's a change of pace, certainly, than what had helped rally this soy complex beginning about a month ago, when it was all the talk about dry Argentina, 100-degree plus temperatures, and crop loss likely. Well, Friday's report, no budge from the USDA on either number, Brazil or Argentina. Some skepticism, right, that we're going to be a long ways out, if ever, from reflecting what could be, crop stress weather-wise as of late for Argentina or Brazil, for that matter. And then we hear from Matthew as well, leading up to this point in the season, a broadly favorable weather for Brazil. Now, if it changes, that can still be something that much more proportionally impacts Brazilian corn and that big safrinha crop that is yet to be planted. Whereas soybeans, we're up against the gun here. They're starting to fill the pipeline here pretty quick. There's already reports of harvest rolling in Mato Grosso. I think Matthew's out having a look at that the rest of this week, in fact. So we'll wait to hear more. But it is a more bearish storyline, I believe, right now, the South American one for soybeans, than it is for corn, with still a lot of time there.
Speaking of corn, looking at a chart here, it looks like maybe our next level of resistance would be the high back from June of last year. Is that the way you look at it?
Yeah, we are all of a sudden reapproaching these seasonal highs that we think of into the spring run up. You look at a chart, and now from a March contract standpoint, a nearby lead month, we're above where we were for basically all of 2024. Continuous chart basis. We've talked about the run up from the late August low. That was around 360 for the September board. Now 478 plus for the settlement. More than $1 gain, of course, from on that upside run. So technically speaking, it is about reapproaching some highs, and now thinking more about 2023 as well, and some highs that now just bring into the mix that psychologically important $5 mark.
Can you throw the wheat market a bone here? Does it have anything it can hang its hat on?
Not much going for the wheat, so it's playing tag along. It should be increasingly a focus for us as we move through the winter and start to take a better tab on what we have growing winter wheat wise. We had that crop report last week that did find winter wheat acreage higher than anticipated, not overtly negatively so, but still leaning bearish. You look at the world markets, and you're not seeing any huge turnaround for the price leaders, whether it's lower or higher, and that would be Russia, France. Now talk about how big these crops have been harvested in the southern hemisphere, Argentina and Australia. And there's just not a real positive storyline to go for wheat right now. It could be that something develops still that pops up with Russia or one of the major exporters. But for now, we're pretty negative about the prospects for wheat trade, especially as the dollars remain so strong. If the corn and soybeans can continue marching higher, you'd think that that would be the only thing that really pulls the wheat along for now.
Well, looking at Chicago wheat, technically speaking, it's been in kind of a downtrending channel for, a long time, all the way back from October of last year. But I will give it the fact that it is testing the upper side of that channel, that descending channel. So I guess if it could maybe take out that overhead resistance, maybe there would be a little hope here. But it
That's
has
right.
to get it done, right?
That's right. Yeah, right back at the upper end of the downtrending channel. We're above the 20-day moving average, but looking like we're heading back for a test of that. If we can hold there, up above the market is 575, the 100-day moving average. You really haven't sustained a close above there for about 3 months. So it would be something if we could gain further strength from here. There's a roughly forming curving bottom, but verdict's out yet on wheat. We won't trust that until we could see some sustained strength. And now just about 4 sessions removed from a recent contract low, it's only corrective in nature, I'm afraid.
Speaking of channels, when you look at live cattle, that's quite an upward channel in cattle. And it doesn't look like they're about to break the downside of that anytime soon either, right?
The speculators are keying in on that, of course. Their computer algorithms see the bullish push to new highs. You have a really key resistance, of course, on the live cattle contracts at 200. You have all-time highs still. We're poking above on the feeders as well that encourage further buying interest. So it is a matter of what gives here. Is it the speculators that are going to be ready to take profit and decide that they want to get out before the others do? You don't want to be the last one out. Eventually, there can be some worry that causes a rush to the exits. But if it's going to be a continued case of fundamental bullishness, they can pick up on that as well. And they don't necessarily have a strong reason to ditch these positions for now. And so they're defending what, for feeder cattle, record price highs, and also a record net long by the managed money crowd. Almost there, pretty close to it on live cattle futures as well. So again, what gives? Is it the speculators turning out, saying they don't like the outside financial markets? Because on today's session, that was actually a source of strength, that you have the stock market rallying such that it is, and supporting, bolstering that fundamental input from the demand side, saying that as much as we talk about consumers potentially pushing away from higher beef prices, the choice cutout rises again this morning. The stock market's rallying like it is, and we're not too negative overall about the consumer position, at least just yet. So that fuels the fire. So is it the speculators that do find a reason to trigger some liquidation, a get out event that ultimately gives the packers, the buyers, reason to inch those cash bids? Or is it the cash side first that pauses because we're beyond this round of catch-up coverage post-holiday? And is it ready a market that's going to see a bit of a lull and a pullback on buyer interest there that triggers some downside for the specs? But for now, you talk about new highs on the charts and the technical bullish. Well, you also still look at the board prices being discounted to the cash trade. So that strong basis premium remaining, like for January feeder cattle that will expire into the end of this month, $4 discount to the real-time index, the CME index, the live cattle that we mentioned knocking on the door of 200, yet cash trade up to 205. So bullish from all sides, but still, a cautious type of approach, certainly as we're talking with our hedgers out there, ranchers, about should we be doing something about it as well and taking advantage. We know why prices could have gotten up to here, but that doesn't mean that necessarily they're going to be able to stay.
So how long are the funds in the cattle right now?
So again, record net long as we're looking for the feeder cattle contracts. That would be a position of over 26,000 contracts. You've got 145,000 contracts last count on the live cattle position, and that would have just been about less than 10,000 short of an all-time record. So really considerable. It's something we talk about actually with the corn market as well. It's not a bearish feature of the market that these funds are as net long as they are, but historically speaking, we are getting to points, whether it's again corn, live cattle, or feeder cattle. The same could have been said recently for hogs, where the managed money position gets to be such a percentage of open interest in the total market that it becomes vulnerable to preceding a liquidation event. a profit-taking campaign that at least triggers a correction for the board. But we haven't observed that yet, of course.
It kind of reminds me of a game of Jenga, where if you take that wrong piece out of that tower, it just all comes crashing down. Is that possible?
It's certainly possible. That's a risk we talk about a lot, that these livestock markets, make V bottoms for one, but also the way that they top out can be, described as the elevator down. And it does fit with what we talk about with that sort of rush for the exit, and the desire not to be the last one holding the longs from the speculative side. And there's good money in these positions, no doubt, with the types of runs that we've had here. So I think it is becoming a market that's vulnerable to that, although it's not likely to get too out of control until you see that break along with it or before the speculative liquidation on the cash in that we talked about. And the cash is what continues to surprise here, that it's holding up as resilient as it is for this time of the season, post holidays, into this period where we thought we could get a bit of a pause in the action.
The hog market makes me nervous. Joe, it just seems like it may be forming a kind of a lopsided head and shoulders. Is that possible?
Yeah, you're looking at an interesting feature of the curve being bear spread right now. So like the April and the June contract stronger today, while the nearby February falls. Normally a bear spread at new highs is not a friendly look. But what we're seeing is that there is still this projection for things to get tighter before we have production again that can swell into the rest of next calendar year. USDA projections having total production up a couple percent. I think there's worry, though, that we won't quite have the support in chewing up these excess supplies of pork from the export market. Still a lot ahead, of course, on figuring out trade policy and how it's going to impact the pork trade. But generally speaking, because the dollar's been so firm and because of the uncertainty, there's been a pullback in pork export demand after what had been, a couple of record strong years and in a really good start here to this year as well. It's just one that, does seem to be slowing in terms of its upside run that we had observed, say, a month ago, when it was more like the cattle in that the speculators had just built up a new record net long and they were really stepping in there to try to defend it. I guess in that sense, playbook for the cattle was that it was eventually a break lower for the pork cutout values and some softness in the cash that really, I think, triggered that technical / speculative liquidation on the hogs. And some uncertainty you can tell, though, by this more active spread and the back and forth, up and down type trade we've observed so often now lately with the hogs.
Well, this is our first full trading week without any interruptions of 2025. However, coming up next week, it's going to be kind of a weird week because Monday we start out the Martin Luther King Jr. holiday. There will be no market trading, I don't believe, on that day. And of course, that's Inauguration Day as well. And then everything resets in Washington, D.C. after that. So the next time I get to talk to you, we'll have a new administration and things could look totally different. So I look forward to our next conversation here to see just how we have to move our sites and change our marketing plans by then.
Yeah, so much can change now within the next 10 days or less. And it goes back to what we looked at this morning and the tailwind that was being provided initially by these outside financial markets, with the stocks up, the dollar index easing down a little bit, interest rates leveling off a bit, a rebound for the metals, some risk on type premium there. Crude oil is as sharply higher as it is here today. Will that environment sustain itself? Because if those things turn risk off, we know that could be that spark that triggers a downturn after this latest rally for at least corn and soybeans.
Well, good to talk with you, Joe. I'll talk with you again with the next administration sworn in. So anyway, we'll catch you then. I hope you have a good week in the meantime. Joe Camp with us from Comstock Investments. And that's going to do it for this episode. I thank you again for joining us. Appreciate that very much. For producer Brienne Jenkins, I'm Marlin Bohling. And we'll catch you next time here on the Comstock channel. Futures trading involves risk. The risk of loss in trading futures and/or options is substantial, and each investor and/or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.